lack of momentum, it appears, is holding back the market right now. You only had 3.4 million shares traded yesterday. Now that's a tenth of what we saw last week Friday. To what extent do you think it's the political risk factors which are holding back the markets?
Well, there have been plenty of political risk alerts. I mean, we've got the ICC decision due on the 23rd of January. We've had the High Court push the general election potentially out to the first quarter of 2013 unless the Grand Coalition is dissolved. And we've got the Al-Shabaab concern, you know, the asymmetric response. We've got a very high alert situation in Nairobi. And I think also we have retail investors, Kenyan retail investors, largely sidelined. The straw that broke the camel's back was the last IPO, Britac, where people are underwater about 50%, and last week got a profits warning. So when you take that in toto, I think the market remains defensive, very beholden to foreign investors. And I don't see many fireworks in the first half. I think a lot of the negative news is baked into the price, but I think we get a move higher in the second half of the year as we see political risk inflect and hopefully abate.
What about the election, though, the upcoming election?
Yeah.
Surely there'll also be a lot of caution until that takes place.
I think, you know, whilst many people are not big punters when it comes to sub-Saharan African equities, and I don't expect big positions to be taken on board ahead of the election, I think you'll start seeing people beginning to nibble ahead of the election. The stock market is, in many cases, egregiously priced. And, you know, historically, we've seen big rallies once the election's out of the way. And I think this time round, we've got enough oversight by the ICC. We've got a very young population. The 18 to 26-year-old age group is where the election is won or lost. And I think these things are tilting the pitch along with the Constitution, which was passed last year. And I think those are the positive elements to look towards. And I think they are going to change the direction of the political curve in Kenya.
Yeah, the agricultural space is one that you've been betting on for some time. We had results coming through from Rea Vipinco. Investors and shareholders are smiling with those results. I mean, 600% rise in turnover there. You've got a dividend payout that's the highest it's been in 7 years. Just run us through those numbers. What were the key revenue drivers for the full year?
You know, overall, I've been extremely bullish this sector because on both on a price earnings basis and on a breakup value, they're seriously undervalued. And this is a classic example. Rea Vipinco's in the sisal space. Sisal prices have been in a sweet spot. And we're finally seeing that primary commodity move begin to feed into the bottom line of these agricultural companies. Rea Vipinco is one of the first ones to show that. You know, this turnaround is something like 600% up on the EPS. And I expect this trend of earnings now to become a new normal. So we got a price earnings ratio here now of 1.88, and every single private equity company that I know of, you know, would snaffle up such a price.
Yeah.
The only issue, if I'm going to be churlish, is a very poor dividend payout ratio, which I calculated at 14%. And I see no good reason that the company is holding their dividend, although they've increased it by 37.5%. Holding it at a payout ratio of 14% is going to keep the price suppressed and is not going to allow it to accelerate to a more fair value. But essentially, if you've got the staying power, these companies are a big give me because they're priced completely egregiously, and this is one classic example.
So even though the dividend really increased by 30 cents there, they need to be rewarding shareholders more for the strong performance. Just going forward, though, the exchange rate and the weather are two factors that Rea has little control over, and two factors that worked in its favor last year. Going forward into 2012, do you think that's going to be the same case this year?
That's a good question. I hope a lot of these agricultural companies locked in the very elevated exchange rate when they could. But I think going forward, you know, my forecast for the shilling is probably a 92 to 84 range, a bias for it to become firmer in the short term, because I think there's a $600 million commercial loan about to be launched for the government of Kenya, which will firm up the shilling a little bit further. The key wild card with the shilling remains the price of crude oil. and the elevated geopolitical curve that we're seeing around Iran and the Straits of Hormuz. And I'm very bullish on the price of crude oil. I think Saudi Arabia is underwriting the $100 mark, and we could see a spike towards 110, 120. So that's my concern around the shilling, because a higher price will surely crater the balance of payments, and that remains the key exogenous risk. But overall, I think we're not going to revisit those levels of above 100 on the Kenya shilling versus the dollar, and we have a bias near term towards a firmer shilling. The inflation rate has topped out now. The journey lower, admittedly, will probably be a sticky one, but nevertheless, I think we're past the apogee on the inflation rate.
And let's look at the banking sector. It rose by 0.5% yesterday. There's said to be a lot of position taking ahead of results being released there. Barclays Bank managed to stage somewhat of a recovery. They're cutting their wage bill, but it's not, and they're also trying to reduce inefficiencies in the system. What is your view on which banks are likely to surprise investors with relatively good results in this environment right now?
That's an interesting question. I think firstly, the banks really did rather well in most cases last year until the fourth quarter, when we had this huge surge in interest rates. We went from a CBR rate of 7% to 18%. That's no small potatoes. And of course, you don't have to be a rocket scientist to know that NPLs are going to increase in that scenario. But the full year results for 2011, on balance, I think are going to be quite muscular. I think KCB will probably show an acceleration year on year of about 50%. I think that looks extremely attractive on a trailing P of 6 or just below 6 ahead of the full year earnings release. Equity Bank has been in a free fall for 12 months now. It's down about 45%. Trailing P is about 8.2. But investors don't like what's going on, especially amongst insiders who've been on the sell side for the last 12 months, and it's not sending the right signal, notwithstanding talk yesterday that KfW might be looking to snaffle up Helios's shares. So I'm looking for low PE, broad-based banks, and in that context, I like KCB, I like the Diamond Trust valuation, and I think I'll just watch and wait a little bit longer to see how the first quarter also plays out, because clearly, when your borrowing rates have jumped from 14 to 25, 26%, there are going to be a lot of people are going to struggle to be making their overdraft and payments to the bank.
Yep, but thanks very much for those insights, Aly-Khan Satchu, CEO of Rich Management from our Nairobi studio.